Hello and welcome from wherever you are joining us today. Now, each week we tackle a new topic relating to your investment journey, and with a team of highly skilled professionals, we can show you how you can invest in property through specialized trusts, which means that you're protecting your assets and your investments for generations to come. Now, one of the guiding rules that led us to create the Wealth Master system is a saying that goes, it's easy to make wealth, but difficult to hold on to it. So that's where we come in to help you and to teach you how you can invest in the best way. Now, today's talking point is all about the art of financing a property through an entity other than yourself. And at the Wealth Masters Club, we will show you how and why purchasing property in trust is the best way to go about investing in property. But to do this, you obviously need to have the right team, you need to find the right property, and you need to handle the transactions in the right way. So to talk a little bit more on this topic, I am joined by our property expert, Emile Grobbelaar. So Emile, thank you so much for joining us today.
Hello, Damien. Welcome. Thank you.
Now, Emile, I'm going to dive straight in, and I think we just need to change a little bit of a perception here where most people think that the only way to purchase a property is in your personal name because that's the way their parents did it, that's the way their grandparents did it. And, I think people are just creatures of habit, and this is the way we've always learned. So what are the other entities that you can use to purchase a property?
Damien, yeah, the trust is obviously our first choice. A lot of people ask the question whether it's not better to do it in a company because of the conduit principle in trust. It's better to do it in a trust. The big argument there between company and trust is, the income tax rate of a company is only 27%, where trust is 45%. But because of the conduit principle, you can get rid of that 45% tax liability in a trust, where in a company, you're going to have to pay 27% before you move the money out of the company. So those are the two entities. It depends on your personal circumstance as well. A lot of people that does not have a lot of beneficiaries that can make use of the conduit principle then prefer to do it in a company, and then the profits stay in the company and they pay tax on it. But people with children and beneficiaries, the trust is definitely the better way to go.
Now, Emile, if somebody has a property in their personal name, which I'm sure will be a lot of people are listening now, what would the process be to actually move that into a trust for protection? And what is the sort of cost involved, and how would they go about that?
Damien, the process of moving, we call it moving, but in effect, it is a sale agreement that is being done between the trust and the person who owns it. Most of the time, it is a trustee as well, but ownership needs to move from the personal name to the trust name, and that is a sales transaction. Direct selling is the quickest way, but it's costly because of new registration costs that needs to be paid on the property. Because it's a new owner. It's the same as any sales transaction. A transaction that we use a lot, and that is purely to defer the registration cost to a much later date, is the Alienation of Land Act transaction. So you sell the property to the trust right now. Ownership is in the trust because that transaction is being registered legally on the property title deed. So the trust owns the property, although the registration is still in the personal name of the seller, but any legal authority is with the trust. So what will happen is at the end of the bond term, when all outstanding debt is paid by the trust, then the property will register to the trust. So only at that point, the registration cost of the property is payable, albeit 10 or 15 years down the line, whenever the bond term ends. So one very important thing to remember, if you do want to sell on ALA to your trust to move the asset, you can't refinance the property during that time, because legally you as the seller are not allowed to incur any more debt on the property because of the Alienation of Land Act, and the banks will not lend any money to the trust, who is the legal owner, because he is not the registered owner. Registration of the property is still in the seller's name. So if you do want to do refinancing on that property in the near future, it will be better to do a direct sale take out a bond in the name of the trust, release the bond on the seller's name, and then you can do refinancing on the property because it will be registered in the trust name as well.
Now, Emile, in the event of someone wanting to buy a property through a trust, but let's say their affordability is in their company and not in their personal name, how will the finance house go about this in terms of looking at their affordability?
Damien, that is not an easy transaction. If you do want to do that, you need to use people that's very knowledgeable about that type of transaction. Bond originators, and only certain ones obviously will do the effort because it is a difficult transaction. The affordability will be in the company, like you said. So they look at the cash flow. Can the bond be paid out of the cash flow of that company? Any and all directors in the company will have to sign surety. Any and all trustees in the trust, who is the purchasing entity, will have to sign surety. So they will still look at the affordability of the trustees as well as the affordability of their personal capacity of the directors as well. So it's a complicated transaction with a lot of information that needs to be gathered and submitted. And obviously your bond originator needs to ensure that the bank knows what the transaction entails. In other words, the entity purchasing is a trust, but the financing needs to be in relation to the income of the company. So that information needs to be relayed to the bank, and that they look at the right thing. They will look at everything as one thing, but they will get as many people as possible to sign surety for whatever debt they are willing to give on that transaction.
And for those at home who have obviously joined one of our events or training before, they'll know that a trust has to have an independent trustee to be deemed legal or active. Now, will the banks take the independent trustee's finances into account when they are getting the approval for bond?
No, independent trustee have no financial gain out of a trust, nor do they have any responsibility for debt. And that will be stipulated in the resolution as well, because the resolution needs to be signed before transaction can be done in a trust. And also afterwards, during bond application, a letter from the accountants of the trust will also stipulate that there is no financial gain or responsibility by the independent trustee to the trust.
Let's just talk a little bit more about purchasing a property through a trust. Can you just give us sort of the general terms that are needing to be followed for that?
Well, first of all, legal-wise, you cannot buy a property or even sign a sale agreement before a resolution is done. If the date of the OTP, the sale agreement, is before the date of the resolution, then it is an illegal transaction and it is not enforceable. Even if the property is registered, the transaction can be reversed. You must do the resolution and sign it before you sign the sale agreement. Then thereafter, what is very important is the affordability of the trustees. All trustees need to submit their information, their financial information with regards to bond application. And then obviously whatever assets and income the trust generates will need to be submitted as well. So in essence, they look at the affordability for the granting of a bond in the same way as when you buy it in your personal name. It's all about the person's affordability to repay the bond, and those people are the trustees of the trust. Those are the basic, most important things that need to be done when you apply for a bond and buy a property. But also a very, very important thing that we run into a lot of the time, the financials of the trust are behind. So don't try and buy property if your financials are not up to date, please. It just causes delays and causes problems.
And then the last question I've got is, what are the terms generally when a trust is being used to purchase a property, but the affordability lies within another entity like a company, as we discussed earlier?
Damien, that's a very important question. Because a company will be the entity that supplies the finance to purchase the property, the bank might look at this as a commercial transaction. Therefore, commercial transactions are not as great as residential transactions. Usually, when you buy commercial property or do finance in a commercial entity like a company, you will have to put down a 30, even to 40% deposit, which is a huge amount of cash. The term for commercial bonds are also much, much shorter. 10 years might even go up to 15, but never 20 years or 30 years. So the very, very, very big thing to make sure that the bank knows that it is a residential transaction and that they consider it in that light so that you will get the proper interest rate, the proper term. Otherwise, your repayment per month will be very, very high.
Fantastic. Emile, thank you so much for taking the time to explain these points in a little bit more detail. Now, if you at home are wanting to find out a little bit more about the Wealth Mastery Way and how it works, then click on the link in the description below and you can register for our free online training, which is taking place this weekend. So we generally have over 600 people joining us every weekend to stream our training. So make sure you are there and you are one step ahead. Emile, once again, thank you so much, and we will chat to you again soon.
Right. Only a pleasure, Damien. Keep well.